A lost decade, the thing that all stock market investors fear. 10 years of having your money invested in the market, but nothing to show for it in the end. This is exactly what happened between August 2000 and May 2013, where it took 13 years for anyone investing at the peak of the dot-com market bubble just before the crash to make a full recovery and see their portfolio turn green again. Now in 2025, with the stock market currently at extremely high valuations, a number of large financial institutions and super investors are starting to warn of another potential lost decade for the stock market. A situation that would see investors achieve little to no gains for the next 10 years, taking both a financial and a mental toll on many. We have recently just seen the stock market experience a notable correction, albeit some of these drops have now partially recovered. But this small decline isn't really changing the fact that right now, the stock market is far more expensive relative to the historic average, according to a number of key valuation metrics. The first of these valuation metrics is the Wilshire 5000 to GDP ratio, often referred to as the Buffett indicator, due to his endorsement where he did say, "It is probably the best single measure of where valuations stand at any given moment." This metric is essentially a ratio of the total value of the US stock market relative to its economic output, and the indicator did peak last month in February at 207%, but is now down slightly to 190%. This period of time marks the highest that the indicator has ever been in history, above the peak seen in the market bubble of 2021 and also eclipsing previous highs that were seen in 2000 and in 2007. And Warren Buffett himself even said that when the indicator is hovering around 200%, you are playing with fire. Now, the forward PE ratio on the S&P 500 has now dropped slightly to 20.5, but this is still the highest that it has been since 2021 as well, which we know preceded the 2022 market crash, which saw the index correcting by 25%. And aside from this time period, you'd have to go as far back as the year 2001 during the dot-com bubble to find a time period where the forward PE ratio on the S&P 500 was this high, and we all know what happened during this market crash. AI hype is undoubtedly one of the main driving factors behind the current high stock market valuation, with a number of tech and semiconductor companies benefiting from the hype. This is especially clear to see looking at the Megacap 8 forward PE ratio being at 25.3, far higher than the ratios of large, mid and small cap stocks, as these megacap companies are the big tech stocks that are driving the AI hype. Some of these companies like Nvidia are seeing increased revenue growth, while others are reliant on potential growth in the future based on their AI tools, but investors do believe that this revenue growth is going to continue or maybe even accelerate into the future. Now, AI is clearly going to be a very important element of our lives in the future, and many companies will indeed benefit greatly from it, but this hype cycle is starting to feel eerily similar to what we saw with the internet companies in the dot-com bubble. The internet, after all, did end up becoming a huge part of everyday life and did change the way that companies operate, but the valuations of internet-related stocks just got way too overheated and reached insane valuations during this bubble, which is why we saw the crash take place, and ultimately these valuations came back down to earth and did settle at more normal levels. Now, Goldman Sachs are one of the global financial powerhouses who do believe that there is a very real possibility of another lost decade scenario taking place, and towards the end of last year, they did release a rather concerning research paper. They stated, "We estimate the S&P 500 will deliver an annualized nominal total return of 3% during the next 10 years and roughly 1% on a real basis. This is a far lower return than the 13% annualized total return that we have seen over the last decade, and some of the reasons for this prediction are very interesting. Aside from the historically high market valuations that we've already discussed, Goldman Sachs do believe that the current highly concentrated market is also a major risk, with the 10 largest stocks in the S&P 500 accounting for a huge portion of the total market cap. They do state that it is extremely difficult for any firm to maintain high levels of sales growth and profit margins over sustained periods of time, and their research does show that there is a correlation between high market concentration and lower stock market annualized forward returns. They also expect equities will face stiff competition from other assets over the next decade, with US Treasuries currently offering an attractive risk-free yield. Future profitability expectations is also another key factor that Goldman Sachs are considering, and this chart here shows that the S&P 500 profitability has risen to be historically quite high at a 20% return on equity. They highlight that profitability is not particularly linear and it is fairly cyclical, falling sharply during recessions and rising during expansionary periods. Now it is clear that right now we are at a peak on this chart, and the historical pattern would suggest that we will soon see the S&P 500's return on equity start to fall sharply by roughly 5% looking at this chart, possibly driven by a potential recession in the near future. And a period of declining profitability would of course have negative consequences on stock prices across the market. But it is not just Goldman Sachs who are fearing a poor performing stock market in the future though, and earlier this year we did see JP Morgan CEO Jamie Dimon express concerns over the health of the stock market, saying, "Asset prices are kind of inflated by any measure." And he did add, "You need fairly good outcomes to justify those prices." But he does seem to be sceptical that this will happen without suffering from the risks coming from deficit spending, inflation and also geopolitical upheaval. And Jeremy Grantham, co-founder and chief investment strategist at GMO, with over $60 billion in assets under management, also did warn last month that the US stock market is in super bubble territory. He highlighted the fact that every measure of traditional value for stocks is at record levels. And we have also, of course, seen Warren Buffett's Berkshire Hathaway continue to stockpile cash and keep his distance from new stock purchases right now. Berkshire has aggressively been building their cash pile to what is now a staggering $334 billion, almost double what it was last year, which also now makes it bigger than their $272 billion, approximately, stock portfolio. And what makes this signal from Buffett even more alarming is that Berkshire have now been net sellers of stocks for 9 straight quarters, with these sales really ramping up in the year 2024, where Berkshire had a whopping $134 billion in net stock sales. And Berkshire have also stopped doing share buybacks of their own stock since May of 2024. All of this activity strongly suggests that Warren Buffett thinks that the stock market is overvalued right now and is positioning Berkshire in preparation for a major stock market correction. And I think it is especially alarming that Buffett doesn't even see his own stock as something worth investing in over just holding cash, when the stock has returned 109% in gains to investors over the past 5 years. But even if we were to ignore all of the things discussed so far in the video to do with the stock market specifically, there is one big thing on a macroeconomic level that is casting a big shadow over not just the stock market, but the overall US economy as a whole. There are a frightening number of historically accurate and reliable indicators that are now flashing red, pointing towards an impending recession, or potentially something worse, hitting the US economy at some point in 2025. And one of these recession indicators is the inverted yield curve, a recession indicator that has not been wrong at predicting a recession for the last 60 years and has correctly predicted 8 out of the last 9 recessions since the year 1960. And in fact, the recent 27-month period of yield curve inversion that we have seen is the longest inversion in all of modern history. Based on historical examples of yield curve inversion and the recessions that followed, we do typically see a delay of roughly 6 to 12 months for a recession to kick in after the yield curve does normalise. Looking at the yield curve today, it is on the brink of normalising, which based on historical data does point to a recession kicking in towards the end of 2025 or early 2026. Since the Great Depression, the US has experienced 14 official recessions, meaning that US recessions do tend to occur roughly every 6 to 7 years, with the average length of a recession being 10 months. Now, technically, we did experience a recession in 2020 with the global pandemic and the damage that this did do to the economy, However, this ended up being an extremely short-lived recession that officially only lasted 2 months, largely thanks to the stimulus money being pumped into the economy as well as aggressive quantitative easing. So if we exclude this recession, the last proper recession experienced in the US was the global financial crisis between 2007 and 2009, which means that it would not be a crazy thing to suggest that another recession could be due. And JP Morgan certainly thinks that the chance of a recession is getting higher, recently raising their risk of a recession chance to 40%, up from 30% at the beginning of 2025. With this potential headwind in mind, this is yet another thing to consider when we try to look ahead at how the stock market may perform in the next 10 years or so. Recessions are obviously bad for the economy, for both businesses and individuals alike, and during periods of recession we do typically see stock prices perform quite poorly, and sometimes that even means a major stock market correction. And this is what did happen during the last 2 major recessions, being the global financial crisis and also the early 2000s recession alongside the dot-com bubble. It is also what happened during the peak fear of the pandemic recession before stimulus money was pumped out and quantitative easing took place. Now, a big caveat to all of this, however, is that things could be different this time. And AI, which I mentioned before, is becoming an extremely powerful technology, and despite the hype around a lot of the AI stocks, the advancements that we are seeing in AI are very impressive, and it could be a key factor driving revenue growth in the future, as well as increasing profitability. The advancement of AI could help to prevent or limit the downside of a future recession in the near term, and no one truly knows where things are going to head over the next decade, more so now than ever before. On top of that, even though stock valuations are by definition pretty high right now, we know that historically time in the market does beat timing the market. There's no guarantee that we see any major market crash anytime soon, and we may end up seeing years of further stock market gains before we see a correction take place, especially considering that Donald Trump somewhat ties his success as a president to stock market performance. The threat of an impending recession is a real one though, and the yield curve is not the only recession indicator that is flashing red and pointing towards an imminent financial crisis. There is in fact a lot of recent data that is coming in that shows very concerning signs, and we are also now even seeing publicly traded retail-facing companies sounding the alarm and warning investors of what could be about to happen. My previous video goes into more detail on all of this, which you can check out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot. And apart from that, thanks a lot for watching.